Hey everyone, welcome back to Corporate Decoder, the place where we decode the secrets that make companies tick, or sometimes unfortunately stop ticking. Today we're looking at Federated Hermes, Incorporated, or FI as they're known, and let's just say they've been busy making a big move. This filing with the Securities and Exchange Commission, or SEC, is a current report, which usually means something significant has just happened. And for FI, something very significant has indeed happened. They've made a big acquisition, buying up a substantial chunk of another company. It's like they're expanding their empire. The main story here is on the 23rd of October 2025. FI struck a deal to buy an 80% stake in a company called FCP Fund Manager, LP, or FCP. Now, what exactly is FCP? Think of them as a real estate investment manager based in the US as of the 30th of June 2025. They were managing a cool $3.8 billion in assets. That is a lot of money, and they also come with over 75 employees. So FI isn't just buying a name, they're buying a whole operation. It is interesting because the report states there are no prior material relationships between FI and FCP. This looks like a completely new venture for FI. Both companies' leadership teams have given this deal the green light. And when do they expect this to all wrap up? They're aiming for the first half of 2026. Of course, there are always conditions to meet, like getting permission from other companies and antitrust approvals, which sounds like a mouthful, but basically they need to make sure no one is breaking any competition rules. So the deal will only go through if these conditions are met. Now, let's talk money. This acquisition is going to cost FI up to $331 million. That is a hefty sum. But here is where it gets interesting. It is not all cash up front. Part of the payment will be $15.8 million in cash and $23.2 million in FIs. Class B common stock to be paid or issued at the closing. The rest, up to $92 million, is what they call contingent consideration. This means FI will pay more money later, but only if FCP hits certain financial goals. Think of it as a bonus for outstanding performance. They're planning to fund the cash part with their own cash reserves and some credit from their existing credit line. This part is a bit technical, but it's actually quite important. Normally, if a company buys another and finds out something was wrong with the seller's promises, they could sue. But here, FI is agreeing not to sue the sellers for most problems unless it is outright fraud. Instead, FI has taken out an insurance policy, a buyer, side representations and warranties insurance policy. This means if there are any hidden issues with FCP that come to light, the insurance company, not the sellers, will likely be on the hook for it. This is a common strategy to keep the deal moving smoothly and avoid lengthy legal battles after the acquisition. The sellers, the ones selling their stake in FCP, have agreed to play by certain rules. Before the deal closes, they have to keep FCP's business running smoothly. They also have to help with getting permissions from clients and take care of employee-related things. And importantly, after the deal is done, they can't just go and start a competing business or poach FCP's clients. These are standard non-compete and non-solicit clauses designed to protect FI's investment. Here is a structural change. When the deal closes, FCP will change its legal structure. It is currently a limited partnership and will become a limited liability company. This is a technical change, but it often relates to how profits and liabilities are handled. After the closing, FI will own 80% of this new company and will control its board of directors. The selling parties will own the remaining 20% and will get to appoint 3 out of 7 directors. FCP's current management team will continue to run the day-to-day operations, and some key managers will sign 5-year employment agreements. This suggests FI values the existing leadership and wants them to stay on board to ensure a smooth transition and continued success. This is a fascinating part of the agreement outlining future ownership. After 5 years, FI will have the right to buy the remaining 20% from the sellers, and the sellers will have the right to sell their stake. To FI, it is essentially a pre-arranged exit strategy for both sides, ensuring how the remaining ownership will eventually be handled. This shows a clear long-term plan for FI to potentially own 100% of FCP down the line. To go along with this official filing, FI also released a press release. This is often a way to announce major news to the public in a more digestible format. They've also included an analyst presentation. This presentation is meant to give investors and analysts a clearer picture of what this acquisition means for FI and FCP. They're providing information about both companies and the deal itself. It is a way for FI to shape the narrative and highlight the benefits of this acquisition. Like many corporate filings, this report includes forward-looking statements. These are essentially statements about the future that are based on current expectations and assumptions. They use words like will, expect, anticipate, and project. It's important to remember that these are not guarantees. The company is saying what they hope will happen, but a lot can change in the business world. They acknowledge that actual results could be very different due to various risks and uncertainties. They are essentially saying this is our best guess for the future, but it might not turn out exactly like this. Now, let's put on our analyst hats and see what this all means. Federated Hermes. Incorporated is making a strategic move to expand its asset management business, specifically in real estate. The acquisition of 80% of FCP Fund Manager for up to $331 million is a significant investment. It shows a clear intent to grow and diversify their offerings. The structure of the deal, with a mix of upfront payment and contingent consideration, suggests they are trying to balance the immediate financial impact with future performance incentives. The insurance policy for representations and warranties is a smart move to de-risk the transaction for FI and keep the relationship with the sellers positive, at least initially. The long-term plan, with options for full ownership after 5 years, indicates a commitment to integrating FCP fully into FI's. Operations, the key risk here, as with any acquisition, is execution. Can FI successfully integrate FCP, retain its key talent, and leverage its capabilities to generate the expected revenue and growth? The market for real estate investment management is competitive, and FI will need to ensure FCP continues to attract and manage assets effectively. The success of this venture will heavily depend on how well FCP, under its current management team, performs and whether it can meet the financial thresholds for the contingent payments. Overall, this appears to be a bold and potentially rewarding move for Federated Hermes. It signals an aggressive growth strategy and a willingness to invest heavily in promising sectors. The future success will hinge on the integration and continued performance of the acquired entity. Alright, that is our breakdown of Federated Hermes' latest filing. What is your take on this acquisition and what it signals for the company's future? Drop your thoughts in the comments below. If this analysis was valuable, hitting that like button really helps us out. And be sure to subscribe for more deep dives into the world of corporate finance. And don't forget to check out our Discord community, linked in the description below for more discussions and insights. Thanks for watching, and we'll see you next time on Corporate Decoder.